In three, two, one. Hello there. Welcome to my live stream. If it's 4:30 Monday through Thursday, you know you have a place to go. You know you have someone who you can count on to give you the update, the skinny. What's important in markets, in personal finance, in making you the boss of your money. Thank you so much for joining me. I'm Mitch Goldberg. You're watching my live stream. It's called Be the Boss of Your Money because I want you to be the boss of your money, not your money to become the boss of you. Couple of things to go into today, in particular, looking for love. Wait, I started by thinking looking for love, but it's really looking for yield in all the wrong places. Tell me if you haven't asked this question if you are a client, a financial services client, and tell me if you haven't heard this question if you're a financial advisor. I want more yield. I don't want to keep living on my principal, digging into my savings. I want to actually increase my cash flow for my investments. Well, now, welcome to the world here, folks. Welcome to reality. This is something I deal with every single day. We're going to talk about these things. We're going to roll the intro. We've got a good show coming up for you today. And here we go. All right, we are just getting started. Welcome to my live stream. It's your live stream. It's Be the Boss of Your Money because you are the boss. So if you have any questions about the topics that we are talking about today, please hit me up in the comments. You know, I love hearing from you. It's the best part of this whole thing, of this show. I love hearing from you. And if you're watching this in the replay, welcome to as well. I'd love to hear from you. So definitely hit me with your questions. I will see them in the comments, in the replay. And for the rest of you, just hang out for a little bit. We're going to learn. We're going to talk. We're going to put things in perspective. You're going to be better with your money. That's what this show is all about. I sure hope you'll be better with your money because if you're not, then it's my fault. I'm doing something wrong. So let's just take it through a couple of things today. First and foremost, we've got a really good show planned for today. I think that every day, though, because I put my heart and soul into the show. If you're watching, while you're watching this, give it a thumbs up, maybe a heart, maybe a care or a celebration, depending on what reaction choices you have on whichever platform that you are watching from. And if you ask me a question, I love it so much. I get so giddy with it. As a thank you, I'm going to show you a picture of the new puppy. Yes, that's right. My wife and I, we picked out a new puppy. So we have a new family member. His name is Benji. And here's a picture. Look at him. Isn't he just precious? I actually cannot wait to get home to give him some hugs and kisses, pet him, and he just is, it's like a love mush. I mean, yeah, 6:15 this morning, he was up ready to go, but so cute, hugging, looking, you pet him on his head and he rolls over on his back. He wants you to give him belly rubs. That's what it's all about, right? My kids are in love with this dog. This dog seems to be in love with us already also. So we've got it going on. All right, so let's just take a couple of things into consideration. The first thing here that I want to show you is Robinhood earnings are out. The stock is down almost $4 after market trading. The company did announce revenue that more than doubled to $565 million last quarter on a huge surge in crypto trading. But other things that I'm reading say that more or less the make that a little bigger so you can see it on your smartphone. Things that I'm taking a look at is it may be that investor enthusiasm has peaked. Most stocks, include especially meme stocks, have really tanked from their all-time highs. And when these stocks go up, they go parabolic. We went over the charts last week. I hope you had a chance to participate in that call, in that live stream. But when a sector that's really hot. You see the rally, the chart go parabolic, and then it goes down. Investors often lose their enthusiasm for trading. So that's just Robinhood down about 3.5. It could change later on. It could change after the conference call. It could change tomorrow. This is just a quick reaction. And let's take a quick look. NVIDIA beats earnings expectations, but cryptocurrency chip sales falter. The last thing you want to hear when it comes to NVIDIA is the word falter. The last thing you want to hear when it comes to an earnings announcement from NVIDIA is the word falter, because this stock is priced for perfection. It's up a hell of a lot. So let's just take a quick look at a quote, okay? That's Jensen Huang, the brilliant CEO of the company. It was off about $4 today, up about 18 cents today. It probably helped that the Nasdaq was down and NVIDIA was down over 2% going into the print. So at least the stock was already knocked down a little bit. So speaking of prints, let's take a look at how the whole day went, and let's just give you the real up. It's not what I want to do. Let's go here. Let's go back to this one. I'm not going to go over every headline today. Okay, it's not a good use of our time. All right, here we go. So the Dow is down 382 points. Yesterday I took the day off. My wife and I celebrated our 29th wedding anniversary on Monday, August 16th. I know a lot of you were out there on that day saying happy anniversary. We both really appreciate it. Thank you very much. It means a lot to me. And the market was down a lot, but by the end of the day, it wasn't so bad. And then yesterday was the day we celebrated. So I took off yesterday, just the way it worked out with the scheduling, with the kids and everything. Yesterday was a good day to take off. So we celebrated yesterday, went out to lunch, bummed around Huntington a little bit, one of our favorite places, went to one of our favorite restaurants, and then we bought a dog, which we had been talking about for ages. We finally worked up the nerve to do it, and boy, are we ever glad we did. And the Dow was down a lot. And I was like, I'm getting the itch, like, ooh, maybe I should do my live stream today. And my wife is all like, no, you took the day off today. That's it. You have to learn how to take the day off. I mean, she's right. You have to learn how to take the day off. Market wasn't down so much yesterday. It wasn't as tough as it was today. So we got through it yesterday. So I wasn't here yesterday. But today, the Dow off about 382, the Nasdaq off 130, and the S&P off 47, down 1%. About 1% down day gets my attention. Nasdaq held up slightly better than the Dow and the S&P, and the VIX just exploded over 20. Remember what I've been saying? Like, if you see the VIX standard 20, good for the market. If the VIX goes above 20, not good for the market. I do look at that as a harbinger of more downside volatility. Plus, it's August. It's a very quiet tape. And the market's just going to be super reactive one way or another to any movement now with volume low. So VIX above 20, not a good sign in my opinion. That's right. This is an opinion show, okay? How about that? Russell 2000 was off 0.84%, down 18 points. And just a tough day. Any more reaction from NVIDIA? Up 60 cents. Anything change with Robinhood stock? Let's see. Did the stock have any kind of bounce? Oh, it's down 277. It was up 3 today. So just giving back what it gained in the regular trading session. Not really that big of a deal. Okay, let's got too many screens open, so let me get rid of some of this stuff. And what are we going to talk about now? Okay, I want you to watch this. All right, I'm going to see hopefully you could see this. I'm going to play a video. And if you can't hear it, that's okay, but I just want you to watch this. All right, and see if you could check this out. Hopefully this will play on the screen. This is a robot from Boston Dynamics, bipedal, so a 2-footed robot. This robot could see, and even though this is a course that the robot has done many, many times, the robot is able to sense changes to the course. This guy right now looks like something you'd see in my gym. This is like stuff that we do in the gym, the jumping around and all that. So here's another one. And, they look somewhat human, like humanoid, little hunched over with a big backpack. But these guys, if you move the obstacles, they could actually see the movement. They could detect the movement of the obstacle. So they're not just like pre-programmed to do a certain course. And yeah, that's pretty freaky, So that is definitely freaky. So what do you think of that? That's Boston Dynamics. I mean, that's about as close as I've ever seen to real life Terminator movie. Like these robots that can move, they can use their hands, they can jump over things, they could hop, skip, jump. Give one of these guys a flamethrower or a machine gun, and you've got yourself a pretty nasty weapon. By the way, Boston Dynamics was purchased by Hyundai, a South Korean company. Kind of surprised that happened, but nevertheless, we'll see what happens. Just something I wanted to show you. I saw it on the internet this morning, and I thought it was a little freaky. Target, though, let's go back to the screen. Target was not a great story. They beat growth, but they fall on slowing store and digital growth. I could see Target slowing on digital growth. I could definitely see that. Let's get a quote here on Target. So I could see that because digital growth, people are going back to the stores. But then, the physical store growth is slowing, and that is a reflection of COVID worries, of the Delta variant. People are just not enthusiastic about going out. We were talking about how we seem to be skating right past the Delta variant, and the situation has changed. If the situation changes, we have to be open-minded to that. So you're seeing the market go down, and you're seeing COVID go up. I do think they're related, of course. Some people say, no, it's not COVID. No, yeah, okay. There's a few things at play. It's not just a matter of COVID, but it's starting to affect restaurants. Airlines are coming out and saying bookings are lower, flights are getting canceled. People are worried about COVID. It's up in every state. Over 90% of all the counties in the United States are in a high risk of people of people catching the Delta variant. I mean, we hear all about Florida and Louisiana and Mississippi and Texas and now Hawaii and Oregon, but it's everywhere. I mean, the Delta variant is popping up everywhere, including where I am in Long Island as well. And I live in an area with a probably 75% vaccination rate for all people who are eligible to get the vaccine. So it's still here. Keep in mind, I know someone's going to say, you see, you shouldn't even bother with the vaccine. You still get it. No. The people who are getting it overwhelmingly unvaccinated people, and the people who are really sick in the hospital and dying from it are like 99% or point something are unvaccinated. All right. I don't want to get, it's not a political thing. This is a science. This is a health thing. Okay. So I just want to take a look, but Target was off $7 in the regular trading. So it's only down 8 cents aftermarket. If Target was closed flat today, then it probably would be down 7 in aftermarket trading. But that tells you something, that Target, which is just such a home run and such a king of the stock market during the recession and pandemic-induced shutdown, and all of a sudden things are slower in their physical stores as well. See, the beauty of Target is that they were able to capture business in the physical store and the digital store and play one off the other. Same thing with Walmart. Doesn't seem to be happening. All right, so let's talk about the big topic today, looking for dividend income or passive income in all the wrong places. Here we go. Looking for love. I did it again. I have to fix it. Hold on. Looking for yield in all the wrong places. I don't know. Is that Willie Nelson who sings that, or Kenny Rogers? I think it's Kenny Rogers, right? Doesn't matter. We're looking for yield in the wrong places. And this is what I mean. I spoke with a lovely individual today, client. He said, I need to start taking some income out. They had a liquidity event, very positive, but there's no passive income coming from the investments. And this is something we've been talking about moving into, but people just automatically expect that they should be able to get 5 or 6% in passive income from their investments. And I'm like, yeah, that went out with like 2004. It's just been so long since we had decent yield. Ever since the Great Recession in 08, 09, that was the end of any kind of decent yields and interest. And when I say interest, I'm talking about bonds. And the beauty of a bond is you buy the bond, it pays a set interest rate. When the bond matures, you still have the principal of your investment and you can reinvest it or just use the principal to spend. And life was so easy. And what I see now with baby boomers, especially baby boomers, and I'm a Gen Xer, but I'm not too far from being a baby boomer. I'm the older Gen Xer. So I heard somebody call themselves a millennial. They were a geriatric millennial because they just turned 40. Does that make me like a geriatric Gen Xer because I'm 54? Okay. So very common question. I want to get more income. And my answer is that, nothing safe pays a good yield. And nothing that pays a good yield is safe. And it's a real conundrum when you are going to retire or in retirement and you've saved and invested and you've got this pile of cash and you expect that pile of cash to replace your income over the next probably 25 to 35 years for most of us. And then you look at it, you say, I'm actually going to be eating into principal pretty quickly to pay my bills because the income from the portfolio is next to nothing. I mean, the 10-year treasury yield is paying what, 2%, right? So this is what I'm talking about. So what happens is baby boomers are going hard and heavy into stocks that pay dividends. As a result, dividend stocks have risen a lot, gotten very high. And that's what it means when you hear the expression, the Federal Reserve has forced people into the stock market. It means that people put their money where they think they're going to get the most amount of growth for the least amount of risk. That's the way it's supposed to be. Right now, I think people are putting their money into the stock market because they think they're going to get the most amount of growth there, but they're not thinking in terms of least amount of risk. No, not by a long stretch. I think the whole concept of risk has it's gone out the window. And I see what baby boomers are doing, and I have clients in this position who are boomers. We're overloaded in stocks more so than I would have put somebody the same age 15 or 20 years ago. And I get it. Yields are different. The financial curve of returns is very different than it used to be. So people are looking they're looking at companies like AT&T, Verizon, a ConAgra, a Procter and Gamble. They're looking at these companies now like, growth and income trades as opposed to just growth trades or just dividend trades. It's a combination. I get that. But I think people are they're buying these for income, not mentally accepting the risk that they're taking, that these stocks could go down substantially, cut their dividends, and people could lose principal. I realize investing, that's part of the game. It's part of what you should expect. But I think people are not expecting that in a lot of stocks that are considered blue chips. And they're just saying to themselves, oh, I don't care. It's Verizon. It pays 4 or 5%. I don't care. It's whatever stock. And yes, it may be a well-regarded company, but you're taking the risk in the stocks where they're in many ways overvalued. And you could say, well, this stock isn't as overvalued as that stock. So relatively speaking, the one that's not as overvalued is cheap. But the whole curve of risk and evaluation has been changed. Some say manipulated because of the actions of the Federal Reserve ever since the Great Recession, when the Fed started doing quantitative easing 1, QE2, QE3, QE4, keeping rates tamped down to zero, all kinds of facilities, and the Fed buys all kinds of securities. It's not the same risk metric that we used to have. The Fed has tamped down risk, which has increased returns by increasing valuations across the board. So nothing's cheap. It's just that some assets today are cheaper compared to other assets. Now, I'm not saying you should get out of the market now and only wait till the market gets cheap again. That's not what I'm saying. The fact is, if you have money to invest today and it's a long-term investment, okay, you'll look back today at today's stock prices and housing prices 20 years from now and say, I wish I could go back to 2021 and get those prices again. Just like everything was overvalued, in the year 2000 and the year 2008, the year that Lehman Brothers blew up, everything was overvalued. But man, look how higher valued things are today than that point. So I'm not saying don't invest. I'm saying if your time horizon is now shorter and you're no longer 30, 40 years out, you're no longer 20 years out, and you're at that point of, I need to start taking money out of my accounts to pay my expenses because that's why you invested in the first place, you've got a problem on your hands. And I'm really coming to you with something that I don't like to come to you with, and that's, we really don't have a good solution. There are leveraged products, leveraged bond products, enhanced yield product. I have to do air quotes because most of these kinds of products, you're taking a much, much greater amount of risk to get a little bit more yield. Remember, investors are supposed to get the most bang for their buck for the least amount of risk. And I don't think people realize that they're buying a lot of junk. A lot of investors are enticed by a high yield from an ETF or a mutual fund that's leveraged with to make it pay more. And investors say, well, all the bonds are, A rated in the portfolio, but it's paying, 6.5%. Must be good. Has nothing to do with the quality of the securities. It has to do with how they're owned with leverage. So while I have you here, I'm going to take a quick gander with you. We're gonna look at some ETFs that do pay dividends, stock ETFs. Okay, we could look at individual stocks that pay dividends, but I think for now, we don't have forever, and I'm going to be off in a couple of minutes from this live stream. I hate when I touch the wire over here. I just like my OCD just kicks in like crazy when I touch the wire or when I make this thing bounce from adjusting it. It's just me. I'm just sharing. Okay, I'm just sharing. Sharing is caring. Let's pop myself up on the screen here. Okay. This ETF is IDV. It's the International Select Dividend ETF, and it goes into international blue chips that pay fat dividend yields. And it's been, I'm mostly up in it, I guess, but it's been around this price between 30 and 35 for years. So no, I have yet to see anyone really make real money in it, but it has held its value. For some people, it's worked out okay. It's having a good year this year. So year to date, it's up 14%. That's great. It's based on NAV, it's up 12.66%. But in the last 10 years, it's up, in the 5% range, which is nothing great if you consider how well the stock market has done from 2011 to 2021. So this has definitely been a huge laggard, but it has worked out a little bit. The expense ratio is nothing crazy. It's from iShares. It's just slightly under 0.5%, 0.49%. Okay. The distribution yield, you're getting 4.29% dividend yield. That's what that means. Is it amazing? It's okay. I would rather have been in an S&P 500 index fund that pays, a little over 1% and made a lot more money on it. But I get you. You're looking for yield, and we don't know what the future is going to bring, but we do know we have expenses coming in now. By the way, the S&P 500 is an index, as you know. You can't invest directly into an index, but you could invest into a security that tracks or mimics an index. So that has United Kingdom, Hong Kong, Canada, Spain, Korea, Italy, Australia, Switzerland, France, Japan. It's international. So for an international investment, international exposure that's dividend paying, this is one way to go. I'm going to look at another one. The next one I'm going to look at is VYM. This is the Vanguard High Dividend Yield ETF. And when I show you what the yield is, you're going to be like, Mitch, you call that a high dividend yield? But this one, the expense ratio is rock bottom, 0.06%. And that is just as low as you're going to get. It's got 411 holdings. Year to date, the fund is up 20%. That's a home run. So people really are interested in buying investment products with yield. And that's what I mean by saying the products that pay good yield, the quality blue chip stocks that you are familiar with, these are up a lot because all the baby boomers are throwing money into these stocks, hoping to get a little bit more yield. And it does make these stocks, I think, stable for now, as long as investors need the income. Will it stay like that? Will there be a generational change when these hands change places to a younger group of investors? If it happens, we'll see. For now, that's not the kind of thing you want to hold your breath for because it'll take literally forever for that to happen. And the stocks in it are JP Morgan, Johnson & Johnson, Home Depot, Procter & Gamble. There we go again. Bank of America, Comcast, Exxon, Pfizer, Cisco, Verizon, and I don't know, a bunch of others. Okay. It's a great idea because you're getting yield, you're getting diversification. Diversification is a strategy that we use to reduce risk. We don't put all our eggs into one basket, but it does not necessarily protect your portfolio from going down in a generally down market. But any of these companies in their own, I would never be embarrassed about. And I always say to people who are investing in individual stocks, you have to know if it's the kind of stock that you believe will always come back given time, or if it's a stock that if it misses, it's never coming back. And you have to decide which kind of stock that you want. You have to evaluate every stock through that very simple view that I just gave you. So this one, the yield on it is 2.71%. And I know what you're thinking. You're like, oh, come on, Mitch, less than 3%? And this thing could be volatile. It could be risky. This fund went down over 30% in value during the Great Recession in 2008. Yeah, it went down a lot. Recovered very well. So no one can complain about that. If you're someone who doesn't need the money so fast, you could handle a 30% correction. The problem with corrections is this. All right. By the way, this is 10-year yield of return of 13%. That's pretty good. All right. The problem with down markets is this. We all say the same thing. It doesn't matter. I'm in it for the long term. When the market goes down a lot and stays down a lot, I'm fine. I'll be okay. I don't need the money now. I get that. And I agree with that. That's how it should be. I have to do the air quotes. Should, because there's should, and then there's reality. And the way it should be is you hold on through down markets with the expectation that they come back. But it's different when you're in the down market. It's a very different animal. When you're in the down market, you start to question things like, well, maybe the conditions that set the market up to go to its all-time highs just aren't there anymore. And maybe they're just not coming back anymore. So that's something that we have to pay attention to. And then you also have to look at what happens if you have individual stocks and some of your individual stocks are not the ones that recover in the next bull market. This is why bull markets are scary. This is why bear markets are scary, because when we have a new bear market, we also always have a new set of negative circumstances that creates the bear market. Stocks are always going to come down in a bear market from all-time high valuations, and everyone will say, we'll never get those high valuations again because the set of circumstances will never happen again. For example, if we go into a bear market starting now, people, investors will say, a lot of them will say, well, we're never going to get this kind of Fed stimulus again. We're never going to get this amount of money pumped into the economy again. So therefore, we've got to get out. That's it. We're never coming back. There's too much government debt, too much printing of fiat currency. By the way, any country that has a central bank that can print money, that's called fiat currency. Okay? Like gold is not a fiat currency, for example. All right? But the dollar is a fiat currency because we can print it and print basically as much as we want. So that's something about the dollar, and that's the difference. This is why people get frightened in bear markets. This is why I always ask, what good is an investment plan if you can't stick with it? So the idea is, regardless of how the market goes, if you have an investment plan that you could stick with, you're better off with that, even if it's a lower risk investment plan, than someone with a higher risk investment plan that could earn higher returns, because the only way they're going to earn those higher returns is if they can stick to it. And what you find out in bear markets, especially a prolonged bear market, that there are so few people who can stick with the plan. That's my thought for the day. Remember, folks, nothing that is safe pays a good yield, and nothing that pays a good yield is safe. And this is why the low interest rate environment has been so hard on retirees and pre-retirees. And as a result, we've got boomers who are so overindulged in the stock market. And as a result, we've got the highest level of risk for the baby boomer age cohort than I have ever seen before in my almost 32-year career. Thanks for watching. I'll be back tomorrow.